So I have two new reports I want to take a look at today from CoreLogic. Now, CoreLogic is a data and analytics company which takes a very deep look into the real estate market. And the two reports we're going to take a look at today have some very surprising data about the 2020 housing market and shed some light on what we can expect to see in the 2021 housing market. So the first report I want to take a look at is titled U.S. Home for Sale Supply Tightens During Pandemic Pushing Up Home Prices. And in this report, it says that the national supply of homes for sale fell to 2.2 months in October, the lowest since 2000, and only about 1/5 of the October 2010 levels. So let that sink in. We have 1/5 of the homes for sale right now as we did in 2010. So if you're a very picky buyer, you have a very specific idea of a home that you're looking for, you're gonna have a much tougher time finding it today than you would have 10 years ago. And this tightening of supplies is not a new trend. For the last 10 years, every single year we've seen fewer and fewer homes for sale in the market, and this is largely what's driving the prices of homes up for the past 10 years. Now, that 2.2 months of supply number is the same number that a lot of the big media outlets are running with, and I've even cited that in my own videos as well. But this report goes on to show that that restraint on supply is actually much more severe in certain price ranges compared to other price ranges. So what they've done in this report is they've taken all of the inventory in the market and they've divided it up into 4 different price ranges and then analyzed how much supplies we have in each of those 4 price ranges. So in the report, it reads that the low price tier had 2.5 months of supply in October 2020, down from 3.4 months of supply in October 2019. The low to middle price tier had 1.8 months of supply in October 2020, down from 2.5 months in October 2019. The middle to moderate price tier had 1.8 months of supply in October 2020, down from 2.7 months of supply in October 2019. And the high price tier had 2.4 months in supply in October 2020, down from 4 months of supply in October 2019. So what this is showing is that essentially the middle price range of homes are what's really feeling that restriction on inventory right now at only 1.8 months of supply. So that's probably somewhere between like the $200,000 to $500,000 price range if I had to guess. I didn't specify that. But the lower price range homes have more supply and the higher price range homes have more supply as well. So even though nationally a lot of people are citing this 2.2 months of supply, realistically, in the price range that you're probably looking at, it's probably closer to 1.8 months of supply, which is astonishing. Now, months of supply simply means that if we didn't have any new homes on the market, how long until every single home in that price range is sold? And so months of supply is dictated by inventory, but also the demand. And so right now we have a very high demand and a very low inventory, which is why months of supply has been shrinking consistently for the past few months. And you often hear the term a seller's market versus a buyer's market, and this is how we determine that. If you have less than 6 months of supply, we generally say that you're in a seller's market. If you have more than 6 months of supply, you generally say that you're in a buyer's market. So we're not just in a seller's market, we're in an extreme seller's market right now. And what's interesting is that for the past couple of years in the real estate community, everybody has been predicting that we're going to have a major shift in the real estate market and go from a seller's market into a buyer's market. Because if you look at the data, there is kind of a repeatable pattern. Like every 7 to 10 years, we have a shift from a seller's market to a buyer's market. But that didn't, in fact, happen. What actually happened is we shifted from a seller's market to an extreme seller's market. But this months of inventory is definitely something that you want to watch. And if you start seeing that number ticking back up, that may be an indicator that we're shifting into a buyer's market, which we ultimately are going to do at some point. It's just a matter of when. The report goes on to say that nationwide, the inventory has decreased 18.5% year over year, with the supply at 2.2 months in October 2020 compared with 3.2 months in October 2019. It then goes on to say that the for sale inventory hit a low in 2020 as many homeowners postponed listing their homes and buyers are motivated by low interest rates. The inventory shortage has intensified upward pressure on home price appreciation as consumers compete for the limited number of homes on the market. So that little paragraph right there is exactly what I've been preaching for the last 6 to 9 months. So in a way, I do feel a little validated that they're seeing on a macro scale exactly what I've been seeing on a micro scale in the real estate market, that a lot of sellers are just too scared to list their homes right now, and they're deciding just to wait it out. At the same time, we have a lot of buyers motivated by these incredibly low interest rates, like once in a lifetime low interest rates, and thus driving up the demand while also reducing the supply. The next report that I want to go over, which CoreLogic just released as well, is titled Forbearance Rates Higher for Higher Priced Loans. So the report goes on to say that higher priced mortgage loans are at more risk when COVID-19 forbearance ends. And as of December 1st, MBA data show that 2.8 million homeowners are in a forbearance plan. The data shows that the forbearance rates are higher for higher priced homes. So I found this incredibly interesting because that is actually not what I was expecting. When you look at the economy, it's a lot of those lower income jobs that are hurt the most and that were actually eliminated. A lot of those lower income workers, a lot of blue collar workers, they can't simply work from home. But on the flip side of that, a lot of those higher income jobs, a lot of the white collar jobs, they can shift how they operate things and simply work from home. So you would expect that the lower income earners who are also in the lower price range homes would have a harder time financially, and you see an increase in forbearance applications from them. But that is not what this data is actually showing. It's a lot of the higher income earners that are filing for forbearance. So the report says that about 30% of homeowners with conventional loans in active forbearance plans in October were current on their mortgage payments. Some homeowners may have applied for forbearance in case their financial hardship worsened, even though they were able to remain current on their payments. And higher priced loans were more likely to experience forbearance than the lower rate spread loans in this analysis. So what I'm reading out of this report is that a lot of the people who filed for forbearance did not actually need it. They filed for it just as a precaution and kind of a loophole to save some money. And I kind of can't blame a lot of these homeowners. I actually considered filing for forbearance as well. My monthly mortgage payment is $2,000 a month. So if I have an opportunity, a once in a lifetime opportunity to go 12 months without making that $2,000 a month payment, that's $24,000. And essentially what you're doing is tacking it on to the end of your 30-year loan. But the average homeowner only lives in a home for 11 years. So most likely you're never going to get to the end of your loan and actually make those payments. So in a lot of ways, you're just saving that $24,000 a year. And so it appears from this data that that is exactly the mentality that a lot of the people have who filed for forbearance. Now, I personally decided not to file forbearance just because there was still a lot of uncertainty around it when they first announced it. And I was a little concerned that it may impact my credit history and it may hurt my opportunities to invest in real estate in the future and take out other loans. There's just a lot of uncertainty of whether it would or not. I personally decided not to, but I don't really blame anybody for deciding to file for forbearance and taking advantage of that. And I think this report also sheds some light on how bad the foreclosure crisis is going to be when it does eventually hit us. So according to this report, we had 2.8 million people actively in forbearance right now, but this report is speculating that a lot of those people only filed for forbearance as a precaution and not necessarily because they could not keep up with their monthly mortgage payment. If you haven't seen my breakdown yet of the housing market report done by Harvard University, you can check that out right there. It has some more very surprising data in there. And don't forget to subscribe for more real estate and financial advice. Hit that little bell icon to get notified every time I upload a new video. Thanks so much for watching, and I'll see you over in the next video.